Hi. Let's learn about bridge financing. Bridge financing, often in the form of a bridge loan, is used by companies and other entities to secure their short-term position until a long-term financing option can be arranged. It bridges the gap between when a company's money is set to run out and when it can expect to receive an infusion of funds later on. Bridge financing can come from an investment bank or venture capital firm in the form of a loan or equity investment. It is also used for initial public offerings or may include an equity for capital exchange instead of a loan. Bridge financing fulfills a company's short-term working capital needs. It comes in the form of debt, equity, and IPO bridge financing. Companies can arrange bridge financing by taking out a short-term, high-interest loan, known as a bridge loan, or by seeking out venture capital firms to provide a bridge financing round in exchange for capital. IPO bridge financing is used to cover expenses associated with the IPO and is typically short-term in nature. Once the IPO is complete, the cash raised from the offering immediately pays off the loan liability. Debt bridge financing involves a company taking out a short-term, high-interest loan, known as a bridge loan, to fulfill short-term working capital needs until a more substantial form of financing can be secured. Companies who seek bridge financing through a bridge loan need to be careful, because the interest rates are sometimes so high that it can cause further financial struggles. Equity bridge financing involves a company seeking out venture capital firms to provide a bridge financing round in exchange for equity ownership in order to secure capital until it can raise a larger round of equity financing. IPO bridge financing is used by companies going public to cover expenses associated with the IPO. Once the IPO is complete, the cash raised from the offering immediately pays off the loan liability. Bridge financing is quite common in many industries, such as the mining sector, which is filled with small players who often use bridge financing to develop a mine or to cover costs until they can issue more shares. Bridge financing can be quite complex and may include a number of provisions to protect the entity providing the financing. These provisions may include an increase in the interest rate if the loan is not repaid on time and a convertibility clause, allowing the loan to be converted into equity at an agreed-upon stock price. Other terms may include mandatory and immediate repayment if the company gets additional funding that exceeds the outstanding balance of the loan. Here are 4 key takeaways. 1. Bridge financing can take the form of debt or equity and can be used during an IPO. 2. Bridge loans are typically short-term in nature and involve high interest. 3. Equity bridge financing requires giving up a stake in the company in exchange for financing. 4. IPO bridge financing is used by companies going public. The financing covers the IPO costs and then is paid off when the company goes public. Hope this would help. Thanks for watching.